Hello, and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 26, 2025, and we are doing an in-depth breakdown of the S&P 500 ETF, ticker symbol SPY. The market is currently at a fascinating crossroads, with major news events creating a tense push and pull between bullish and bearish sentiment. First, we'll cover the latest headlines driving the market, and then we'll dive deep into the charts to see what the price action is telling us. Let's get right into it. On the news front, the biggest story continues to be the volatility in mega-cap tech stocks, particularly Nvidia. We've seen reports of overstretched valuations and potential competition from Google causing significant slumps in Nvidia's stock. This has created a ripple effect, weighing heavily on the Nasdaq and the S&P 500 as investors worry about a potential AI bubble. However, yesterday the broader market, especially the Dow, managed to rally despite Nvidia's weakness, showing some underlying strength. Counterbalancing the tech fears is a surprisingly strong outlook from the retail sector. Major chains like Walmart, Best Buy, and Kohl's have raised their annual guidance, suggesting they anticipate a solid holiday shopping season, which is a great sign for consumer health. Another major factor is the ongoing speculation about the Federal Reserve's next move. Comments from New York Fed President John Williams have hinted that rate cuts could be possible in the near term due to a softening labor market. This has the market pricing in a higher chance of a rate cut in December, which is generally bullish for stocks. However, conflicting signals from other Fed officials and a recent delay in consumer inflation data have kept investors on edge. So we have a classic battle: tech valuation fears versus hopes for a Fed pivot and a strong consumer. Now, let's turn to the daily chart and see how this narrative is playing out in the price action. Looking at the bigger picture, SPY has been in a strong uptrend since the major lows back in early April of this year. The market rallied impressively through the summer and early fall, setting a new all-time high around the 688 to 689 level in late October. Since then, however, we've seen significant volatility and signs of distribution at these higher levels. Most notably, we had a massive sell-off just last week on November 20th. The market gapped down and sold off hard, dropping from around 672 all the way down to a low of 652. This move coincided perfectly with the news of Nvidia's sharp decline and renewed fears over tech valuations. That day saw a huge spike in volume, well over 165 million shares, which tells us there was strong conviction behind that selling pressure. This establishes the low of that day, around 652, as a critical short-term support level. Following that drop, we've seen a strong two-day rally on November 24th and 25th, showing impressive resilience. The price has reclaimed a significant portion of that drop and is now testing a key resistance area. Let's zoom in on the last few months to get a clearer picture of this recent price action. Here on the daily chart, starting from September, we can clearly see the strong uptrend that led to the October highs. But notice the character of the market has changed recently. We are seeing these sharp, high-volume down days, like the one on October 10th and the more severe one on November 20th. These moves suggest that large institutions may be selling into strength. The area between 670 and 676 has acted as a repeated point of resistance. The market has struggled to sustain any meaningful move above this zone. The bounce from the 652 low is encouraging for the bulls, but we are now right back at this major resistance cluster. A failure here could easily set up a lower high, which would be a bearish technical development. Conversely, a strong break above this area could invalidate the bearish pressure and signal a continuation of the primary uptrend. Switching over to the 1-hour chart, we can get a much better feel for the short-term trend. Here you can see the waterfall decline on November 20th and the subsequent V-shaped recovery. Since hitting that low around 660 on the hourly close, we have been putting in a series of higher lows and higher highs, which is the definition of a short-term uptrend. The rally yesterday, November 25th, was particularly strong, breaking above several minor resistance levels. The price is now consolidating right below the 676 resistance level. This is the moment of truth for the short-term trend. Bulls want to see the price push through this level and hold, turning it into new support. Bears are looking for a decisive rejection here, which could send the price back down to test support levels at 670 and then 665. Now let's drill down even further to the 15-minute chart to analyze the most recent intraday action from the past 2 days. On November 24th, we saw a gap up and a steady grind higher throughout the day, building a solid base. Then yesterday, on the 25th, after some morning chop, we saw a significant surge of buying pressure in the afternoon session. This push broke the market above the 670 level with conviction. The price is now in a tight consolidation range just below the key 676 resistance. This sideways price action is a sign of equilibrium, where buying and selling pressure are temporarily balanced as traders decide on the next directional move. A breakout above this range, especially above 676, could trigger another wave of buying. However, a breakdown below the recent consolidation low around 674 could signal that the upward momentum is fading and a pullback is likely. This is the immediate battleground to watch as today's session gets underway. So, to recap everything, let's bring back the daily chart and outline the key levels and potential scenarios. The most critical resistance to watch is the immediate zone of 675 to 676. Above that, the next major target for bulls is the all-time high area around 688. On the downside, the most important support level is the November 20th low at 652. A break below this level would be a very bearish signal and would likely lead to a much deeper correction. Secondary support levels can be found around 665 and 660. Now for our unbiased predictions. First, the bullish scenario, which I would assign a 60% probability to in the short term. This is based on the strong rebound from the lows and the positive underlying economic sentiment from retail and Fed pivot hopes. If SPY can break and hold above 676, it would reinforce this view, and we would look for a move towards 680 and higher. Next, the bearish scenario, which I'll give a 40% probability. This would involve a failure at this 675 to 676 resistance zone. If we see a sharp rejection here on high volume, it would confirm that sellers are still in control at higher prices, likely driven by ongoing tech valuation fears. A subsequent break of support at 665 would strengthen this bearish case, putting the 652 lows back in play. Things to watch for in the coming days are any Fed-related news, the delayed inflation reports when they are released, and the price action of key mega-cap stocks like Nvidia. Their behavior will likely be a leading indicator for the broader market's next move. That's all for today's analysis of SPY. I hope this detailed breakdown was helpful for you. Please remember that this video is for informational and educational purposes only and should not be considered financial advice. Trading and investing involve risk, and you should always conduct your own research and consult with a qualified professional before making any investment decisions. If you found this video valuable, please hit the like button, subscribe to Explain the Charts, and ring the bell so you don't miss our future updates. Thanks for watching, and we'll see you in the next one.